The economic team of President Bongbong Marcos retained its annual growth target bands until the end of his term in 2028. Let's get the insights of Rajiv Biswas, Executive Director and Asia Pacific Chief Economist of S&P Global Market Intelligence. He's based in Singapore, but he joins us now in Manila. Rajiv, great to see you once again.
It's a great pleasure to be in Manila.
So, Rajiv, tell us, the economic team said that for 2023, they have retained the 6 to 7% growth target. For S&P's view, is this attainable?
We do expect that the Philippines economy will grow towards the lower end of that range. We expect growth of about 6% for 2023, and then another strong year next year. So we do expect a pretty robust outlook for the Philippines economy in the coming couple of years.
Why is your forecast on the lower end of the 6 to 7% target? What kind of challenges will the Philippine economy face this year?
Well, there are some base year effects because last year was so strong. Last year was the strongest growth since 1976. So after such strong and buoyant growth, this year will be somewhat more modest. But it's still a pretty good growth rate of 6%, supported by strong private consumption and also rapid growth in public infrastructure investment. I think one of the headwinds facing the Philippines economy is the weak external markets in the US and in the EU, and that has already hurt electronics exports from the Philippines. We've seen quite a weakening of electronics exports in the last few months. So I think that will be one of the challenges facing the economy. But there's many positive factors helping growth.
All right, headwinds from the United States and from the European Union. What about China? It is a major trading partner of the Philippines. We saw a rebound in China's economic growth in the last quarter. Could this also help push or boost Philippine economic growth amid the headwinds in the US and the EU?
We certainly did see headwinds also from China in the second half of last year, impacting on Philippines exports. But that situation is now shifting quite significantly because of the rebound following the post-COVID reopening in China. And so as the year progresses, I expect that we'll see stronger demand for Philippines exports coming from China. So I do think that China will help to mitigate some of those headwinds to the export sector coming out of weak demand out of the US and EU. And I think going into next year, we will see the US and EU markets also improving. So I think the medium-term outlook is for better exports of goods. And of course, we have to also remember that tourism is going to be rebounding quite strongly this year. So the overall picture of exports of both services and goods will be getting quite a big boost from the recovery of international tourism, including from China, of course, as well.
All right, apart from the pandemic that hit many major economies, you also had last year the Russia-Ukraine conflict, which basically had a major impact on interest rates and inflation. What about the little financial shocks that we saw in the United States with some smaller US banks being hit? Could this get any bigger from what it is now? Or is that risk ended?
I think that risk has been substantially mitigated by the rapid action of the US regulators. So they intervened very, very fast to stabilize the US financial system. And I think that rapid action helped to limit contagion. So far, what we're seeing is that the financial turbulence has diminished quite substantially. Of course, there's still fundamental issues about bond exposures that have not gone away completely, but I think the actions of the regulators have been so rapid, it's really helped to stabilize the system. And I think the risks to the outlook are very much mitigated coming out of the US financial system.
So, Rajiv, you're not expecting any kind of economic or financial shock, particularly from the major global economies, anytime soon?
I think one of the risks to the outlook is from the US and EU inflation, because although inflation is starting to come down, in the US and EU, the risk is that it may not come down fast enough for the central banks, for the Fed, for the ECB. They want to see evidence that inflation is coming back to their target range. And if that moderation of inflation isn't happening quickly enough, we could see more tightening coming from the Fed and the ECB. And that in turn would squeeze the financial system. It will put more negative pressure on interest rate sensitive sectors in the US, such as the residential construction market. And that in turn does have transmission effects to Asia as well.
We say transmission effects to Asia. Could we also be importing this inflation from the United States, and this could lead the Philippine Central Bank to raise interest rates yet again?
I think the big picture is really one where inflation is coming down. So what we see in many countries around the world where inflation had picked up in the last 12 months is that the pace of inflation is moderating, and that is also evident now in the latest data for the Philippines CPI. So I think the outlook is that inflation in the Philippines in the base case is moderating. We expect that by August this year, the inflation rate in the Philippines will be down slightly below 5%. And by October, we expect the CPI inflation rate in the Philippines to be slightly below 4%, which brings it within the target range.
You're quite optimistic about the Philippine inflation rate because the Bangko Sentral ng Pilipinas, the Philippine Central Bank, is still keeping its inflation rate levels up to 7%.
They need to be cautious because at the moment, inflation is above 7%. So I think we need to see the evidence that inflation is actually coming down. But we've just seen the announcement today that fuel prices in Philippines will be lowered. Those sort of indicators are showing that inflation will be moderating in the coming months. But I think the central bank clearly needs to see evidence before they can make any change in policy decision. So before they can shift towards being on hold or even consider easing, they really need to see some concrete evidence that inflation is coming back to within their target range.
You're very optimistic about the infrastructure and travel and hospitality industries here in the Philippines. Which sectors would be vulnerable in 2023 and going forward?
I think actually tourism is going to have a good year because we're seeing a big recovery in global travel. So that's going to be one of the sectors.
But which sectors will be vulnerable?
I think what we're seeing is weakness in the electronics export sector. That's been evident for some months because of weak markets in the US and the EU. And also China was very weak as a consumer market in the last 6 or 7 months. So I think at the moment, the electronics export sector, which is very important for Philippines manufacturing, is going to continue to face headwinds. Gradually, we should see that as Chinese consumer demand improves, that may help to mitigate it. But I think really we need to see the US and EU consumers coming back into the market before that sector can turn around.
With the target at between 6 to 7%, which makes the Philippines one of the best performing economies for this year, if that target is indeed attained. Is there still a need, Rajiv, for the Philippine Congress to revise economic provisions in the Constitution to further boost the economy?
I think really the Philippines will be performing very strongly in the next couple of years. But fundamentally, I think there are needs to really ramp up infrastructure in order to compete with other Southeast Asian countries. Vietnam is a very strong competitor to the Philippines, so is Indonesia. So I think we're going to need to see, more initiatives from the government in the Philippines.
But should they tinker with the Constitution, open it up and change some of the economic provisions?
I think it's, obviously the government can take reform measures in order to improve the environment in a number of ways. So I think it's fair enough for the government to consider economic reforms that will further boost the economy. Because in the end, the target of Philippines should be to become a middle-income country within the next decade, and some reforms will be needed on the economic front. And I think positive, dynamic reforms will definitely help. We do have a fairly optimistic view that the Philippines will become a $1 trillion economy by 2033, within a decade. So I think the economy of Philippines will be one of the best performing emerging markets over the next decade. But I think one of the important underpinnings for that will be continued economic reforms, particularly to attract foreign direct investment. That's going to be a big challenge because Philippines has to compete with competitors like Indonesia, with Vietnam, who are already attracting a lot of foreign direct investment inflows. So some economic reforms are needed, I think, to make Philippines more attractive for global multinationals in competition against other Southeast Asian economies, and of course India as well, which is another big competitor on the doorstep.
Thank you so much for joining us in The Final Word and sharing with us your insights on the Philippine economy. Rajiv Biswas, APAC Chief Economist, S&P Global Market Intelligence.
Thank you so much.